what we want to kind of do again each month and really kind of consistently is figure out where the narrative is, figure out where the internals are, really kind of take a broad look at the market. We think the narrative is still very optimistic. It assumes that rate cuts will begin around April to May. So that's slipped from March, but it hasn't slipped very much. And they were still looking to get at least 5 to 6 rate cuts through 2024. As we've said, historically, within a year of Fed tightening, that's only happened in recession since World War II. The assumption is we're going to get a soft landing with no significant deterioration in growth. And so far that's developing, but there's concerns there we want to watch for. And then the earnings gains that are being projected are very strong. They're about double the normal year, with the thought being that AI and big caps is really going to raise productivity and raise those earnings quite a bit. And then both geopolitical and domestic political risks are minimized. And we'll kind of go into why is this, how do we know that's the narrative and what shows you that? But really, when you look at the broad markets, that's what we see. So the first one we're talking about is number one, rate cuts beginning April, May, and 5 to 6 rate cuts a year. And you can get this really clearly from the Fed funds futures. You look at the March, you look at the D's, and you can see, okay, what are the odds that March is pricing in a cut? And it was over 50%. And for a while, it was as high as 70%. It's fallen as low as 20%, 20, 30% right now, but still April, May cuts are still being priced in at a very high reliability. And then we're still looking at a similar year-end 4% Fed funds rate. So we're talking 5 to 6 rate cuts. So that's really what the markets are saying right now. The soft landing scenario, one of the things we can do to see that is we can see what is the PE on the forward earnings estimates that everyone's making. So first of all, we can see those forward earnings estimates are calling for 10, 11, 12% earnings gains. And we can see that we're at 22.44 times those forward earnings. That's very historically high valuation. And that's something that basically is saying that the market's not really concerned about any kind of growth slowdown. When you start having scares of growth slowdown, you start getting 17, 18 times. And at these interest rates, sometimes even lower. So the market is very confident we're going to have a soft landing. And we can see that in the PE ratio of the forward earnings. And then we take a look at earnings estimates, and for the S&P, 245 is kind of where we are in terms of the average estimate. And that's about 11% earnings growth, which is pretty much about twice what normal is. So a lot of that is focused in the AI and the big caps, but that's very strong earnings growth. Doesn't mean it can't happen. It's just important to understand what the market's pricing in. The other thing I would say is that geopolitical concerns are really minimal. How do we know that? Well, we look at the dollar and we look at interest rates and we look at crude oil, right? If we had we've got kind of tit for tat little battles. We bombed a couple more people over the weekend, and, the Houthis are announcing they're not going to stop. They're going to actually increase their, et cetera. So there's a lot of stuff going on, little mini proxy wars that are going on. But look at oil. Oil is relatively unconcerned. It's bounced off our major support zone from 64 to 70, and then come back down off of 200-day moving average. Really need to get above kind of this hot HVN here in the mid 80s. To really suggest that the market's starting to get concerned. And this downtrend line that's on a weekly and monthly charts, that if we get over that, that's starting to tell you that geopolitical concerns are really heating up. Right now, we're just not there. Another thing, to realize is that it's one thing to look at valuations and PEs. It's another thing to look at them in relation to bonds. And in relation to bonds, we're very, very overvalued right now. And so that's also telling you the market is very confident that, and it's all, one thing I want to point out is even when we got to October of last year, the valuations based on interest rates on the TNX yield were not in any kind of low level where you would expect a cyclical bottom. Usually at cyclical bottoms, you get, decent valuations that kind of give you some wind at the back so that if earnings grow, also PEs can grow and you've got sort of leverage on the upside. Don't really have that to a large extent. The other thing I would say is the market is very confident that inflation is going to be coming down sharply and consistently, and that's why it's pricing in 5 to 6 rate cuts. But when we look at inflation ourselves, we're not really sure that decline in inflation is really going to continue. It can, but we've got some signs. We've got a number, the Atlanta Fed core sticky CPI, the Cleveland Fed median CPI. These are both probably third and fourth strongest indicators that the Fed watches. They both picked up in the last few months, and they continue to rise. And then on Friday, we found out that the average hourly wages are increasing now at 4.5%. Well, Powell has basically said anything above 3% is just not going to get the Fed to the target rate, and we're moving the opposite direction. And then when you look at the 1970s sort of inflation, prognosis, it's really correlated quite well with what's happened, but I want you to see that it starts to pick up here. So we kind of want to be watching for this. Isn't enough to upset markets yet, but it's getting to the edge of where markets are going to pay more attention, and particularly bonds are going to pay more attention. And so we really want to start watching this as it's a risk because the outlook is calling for something different than what we're seeing. The other thing we pointed out last month, the situation in the Middle East and how shipping has really been diverted around the Cape Horn of Africa and not going through the Red Sea, and we can see the plummeting in total shipping that's going through the Red Sea zone. And today we had ISM prices paid explode with the highest increase we've seen really since the inflation scare last year. And that is coming from transportation impacts of the Suez Canal due to unrest in the Red Sea. So we're just getting a glimpse of the impact just starting to show up on some indicators of this problem of higher costs, and it's leading to big prices paid increases for services. The other thing I want to point out is we have two former fairly well-renowned Treasury Secretary. They're former Democrats, right, from Clinton and from Obama, and both of those former Treasury secretaries in the last week have warned about long bond problems ahead because of the massive deficit. That's a huge supply versus demand. And so Rubin has said when markets are this out of whack, they can make fast adjustments. So we want to watch out for interest rates. We've been talking about that. We have a lot of things we've talked about. There's potential for a growth scare. But interest rates are really kind of a big one. And then the other thing we're going to talk about is that this is not yet, and we've been looking so we got a nice correction over signal beginning of November and had a nice run off that, a better run than we thought. But we haven't had the broad market really take off with the big caps. And for the big caps to be able to continue, unless we're just in a blow-off situation that can go for a while, but then it's going to create a major, major problem. We really need, and even for the blow-off to continue, we really need some better performance out of the broad market. So, to take a look, this is the Mag 7, and that's really where most of the gains have been focused. And Mag 7 is up a huge percent in the last year and a half or so, while the market without the Mag 7 is barely up. It's not even up double digits. So it's a huge, huge difference. And if you look at the earnings difference, also huge, right? Mag 7 earnings are going nuts. The rest of the earnings, they're actually still down. Looks kind of like we're in the middle of a recession for the rest of the market. So you just want to understand when markets are narrow, they're at their highest risk. And when they're broad, they're the safest. And so we're not in a safe environment. It could be one where certain sectors explode higher, like we had from 1998 to 2000, but it's not one where the broad markets can be taken. Look at TNX. So remember, we've been focusing on this heavily. We talked about in August how this breakout above 4.09 past highs would likely be a negative impact for stocks. And really, as soon as we had that, we started the correction in the market for the next few months. And that correction continued until we got sort of a double top breakdown and a big gap down in TNX rates that suggested that rates were done moving up for a while, and the market's taken off since. Now, though, we're really kind of in a pattern, the opposite of what we've got here. It's a potential double bottom, and if we close above 4.2% in TNX, we think there's going to start to be some spillover damage to stocks, and it's going to start to be more of a headwind. Stocks are going to have to take notice, and then above this 4.4, that could really lead to bigger problems. So there's a lot of risks out there. We want to watch them. If none of them happen, you just keep raising your trailing stops in the strongest instruments and let them run. But you also want to be watching out for the kind of risks that we have, and there are a lot of them out there. And you can see that the NASDAQ normally very highly correlated over the last few years in particular with moves in the TNX rates. And there's a huge gap developing. And those kind of gaps tend to lead to corrections eventually. Now, we've been talking about how it's the big cap, it's the Mag 7, and it's not the rest of the market. And here's a couple charts that'll help you visualize that. This is actually the broadest, the most inclusive index out there, the value line. It includes more stocks than any other index. And you can see that we don't have a bull market in the broad market. We have a big trading range since May of 2022. And we have relative strength declines for the broad market. And if you look at small caps, they've really backed off with the broad market since the late December highs. And they've been in this kind of range that we've been watching associated with weekly and daily volume nodes. And they're inches from really breaking down. Closing below 192 would be a negative, and that's also potentially closing below this uptrend channel, whereas closing above 200 would be telling you, all right, small caps are starting to kick into gear more. Maybe we've got some room to go for the big caps. Now, it's not just small caps. It's mid caps, and it's also a lot of important sectors. Transports. Big trading range. That's not making new highs. Banks are pretty important. They're in a big downtrend. So it's not just that there are certain sectors that are participating on the upside. You really want to be very selective in the ones that are outperforming on your upside exposure, but you also want to be cognizant that the broad market and many sectors are really lagging in a way that's historically becomes more dangerous the longer it lasts. The other thing to point out that is a risk that we really want to watch. We're not sure it's going to develop. We've been watching for this head and shoulder breakout in China for a long time. It just hasn't happened. And in fact, we're now retesting the lows. So China having a recession and breaking below these lows, these lows are down like 65% over a 2-year period. We break below those lows in the second largest economy in the world. That's likely to start to have increasing spillover damage. We can already see some spillover from China and South Korea and some other Asian markets, but I think making new lows will be enough of a shock that even the US market's going to have to start to notice. So if we're not sure this is going to happen, we suspect we're going to get more policy acts to try and hold these levels. But so far, the market has not been respecting the little dribbles of policy acts that China has been putting out. And so we really want to watch if we start breaking down to new lows, clearly in FXI and MCHI and some of these bigger Chinese market in dollar terms, that's going to start to have impact and spillover damage even to the US market. We still want to be watching throughout the year, even though we really don't, we have some inklings, but really not clear evidence of any kind of growth slowdown. And so we want to keep an eye on this throughout the year, be watching for the unemployment rate to pop above 4.1 and for the 210 yield curve to go to uninversion, which it usually does when the economy starts to slow after prolonged inversions.